Ever wondered how the world's first central bank came into existence? Let's embark on a journey back in time, to the late 17th century. The concept of central banking, as we understand it today, was still in its infancy. In essence, a central bank acts as a financial custodian for the nation, controlling the monetary policy, ensuring economic stability, and serving as the lender of last resort. Now picture London in the year 1694. The Bank of England was born, not as a government entity but as a private institution. Its primary role? To fund the deficit of the government, which was engaged in a costly war. This was a novel idea, a private entity effectively aiding the government in its financial needs. From its humble beginnings, the Bank of England set a precedent for what was to become the modern central banking system. As time went on, the Bank of England evolved, embracing new roles and responsibilities. Initially a private institution, it gradually morphed into the central bank of the United Kingdom. Its evolution was marked by a series of milestones that not only shaped its identity, but also the very concept of central banking. One of its key roles involved setting the monetary policy. The Bank of England assumed a crucial position in managing the country's money supply and interest rates, hence steering the economic direction of the nation. In addition, it took up the responsibility of issuing national currency. This meant that the banknotes you see today, those crisp pieces of paper adorned with the Queen's portrait, are a testament to the bank's pivotal role. But the Bank of England's influence didn't stop at monetary policy and currency issuance. It also served as the government's banker, managing the country's treasure and ensuring financial stability. A significant turning point in the bank's history was the passing of the 1844 Bank Charter Act. This legislation granted the Bank of England the exclusive right to issue banknotes in England and Wales, solidifying its status as the central monetary authority. The Bank of England's evolution set the stage for the establishment of other central banks around the world. It serves as a shining beacon in the annals of economic history, illuminating the path for financial institutions across the globe. Fast forward to the early 20th century, and we see the birth of another central banking giant, the Federal Reserve. The year was 1913 when the United States Congress decided to establish the Federal Reserve System. But why, you might ask? The answer lies in the need for a safer, more flexible, and more stable monetary and financial system. The U.S. had experienced numerous financial crises, and the government recognized the necessity of a central banking structure to prevent such episodes. The Federal Reserve structure was designed to balance the competing interests of private banks and the public's welfare. It was made up of 12 regional banks scattered across the country, each serving a specific geographic area. These regional banks operate independently, but under the supervision of a central governing board in Washington, D.C. This board, known as the Federal Reserve Board of Governors, has the power to set monetary policy. The regional banks, on the other hand, are responsible for implementing these policies within their jurisdictions. Together, these elements create a unique blend of centralized and decentralized authority, designed to ensure the smooth functioning of the nation's economy. The Federal Reserve, much like the Bank of England, has undergone significant changes since its inception. Yet, its core mission remains the same: to strive for a stable and secure financial system that serves the best interests of the American public. The Federal Reserve's journey has been one of adaptation and transformation. As it navigated through the tumultuous seas of the 20th century, the Federal Reserve found itself at the helm of America's economic ship. One of the crucial moments in the history of the Federal Reserve was the Great Depression in the early 1930s. The Fed was criticized for not doing enough to prevent the economic catastrophe. In response, it adopted a more active role in managing the economy, using monetary policy as a tool to control inflation and stabilize economic growth. Then came World War II, a period that saw the Federal Reserve play a vital role in financing the war effort. The Fed bought government bonds to keep interest rates low and ensure the government had the funds it needed. This period marked a significant shift in the Federal Reserve's role, from a passive institution to an active participant in the nation's economic affairs. Fast forward to the financial crisis of 2008. The Federal Reserve once again found itself in uncharted waters. It took unprecedented steps to stabilize the financial system, including slashing interest rates to near zero and buying massive amounts of securities to pump money into the economy. These actions underscored the Fed's evolving role as a guardian of financial stability. Over the years, the Federal Reserve has also expanded its supervisory and regulatory responsibilities. Today, it oversees the nation's largest banks, ensuring they have adequate capital and are not taking excessive risks. It also works to maintain the stability of the financial system, stepping in when necessary to prevent a crisis. The Federal Reserve's journey is a testament to its ability to adapt and evolve in response to changing economic conditions and challenges. It has gone from a passive institution, primarily concerned with maintaining the gold standard, to an active player in the economy, with a broad mandate to maintain financial stability, conduct monetary policy, and supervise and regulate banks. From the Bank of England to the Federal Reserve, central banks have played a pivotal role in shaping economic history. So, what can we learn from the history of central banking? From the birth of the Bank of England to the evolution of the Federal Reserve, central banking has played a pivotal role in global economics. It's a journey of innovation, resilience, and adaptation. The evolution of these institutions, their strategies, and their roles in stabilizing economies provide invaluable insights. As we navigate the economic challenges of the 21st century, the lessons from the history of central banking become ever more pertinent.